The conceptual framework tells us that for information to be useful, it must be both relevant and a faithful representation. And I want to talk to you about relevant information and give you some practical examples of how information is relevant. But relevant information is information which is capable of making a difference to the decisions made by users. If information is irrelevant, no one bothers. No one looks at it. And information is relevant if it has a predictive value or a confirmatory value. So let's look at various accounting standards and see to what extent they're going to contribute to the usefulness of financial statements. First of all, IFRS 5. Assets held for sale, discontinued operations. Now, for me, I'm going to argue that this standard really enhances the relevancy of information. Information is relevant if it is predictive. So if you classify a non-current asset, if that asset is classified as held for sale because you're at the reporting date, you've committed to selling it, there's an active plan to selling it, it's in a suitable condition for immediate sale, blah, 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 then the accounting treatment by the standard is to show that item, which would normally be a non-current asset, it's reclassified and it's presented as a current asset, and there's an impairment review that goes on, and it's written down to the lower of, if necessary, how much you're going to sell it for. Because that's how you're primarily going to recover the value from the asset. So to me, that's relevant because you're predicting that the asset is not going to be there next year, which is why you're showing it as a current asset, and you're writing it down. You're ceasing to charge depreciation. I love the relevancy embedded in IFRS 5 when an asset, an item of PPE, is classified as held for sale and therefore presented as a current asset with depreciation ceasing. Earnings per share, EPS, ISA 33. Is that giving you relevant information? Well, if I go for the low-hanging fruit, the answer is yes. When we publish a diluted earnings per share, a kind of what-if earnings per share, what if the options were exercised? What if the convertible loan notes became equity? What if? You're then producing an EPS. And if that diluted EPS is a warning, it's not necessarily a full predictor, but it's a warning to the investors that things could happen in the future, that even if the earnings capacity basically remain the same, that their earnings per share would go down. So to me, it's relevant for an investor to know if there are lots of options, if there are lots of convertible loan stocks out there, how that will affect their EPS, their earnings per share in the future. And diluted earnings per share goes a long way to help them understand that. You can also argue that earnings per share is of a confirmatory nature, given that it's published every year, and a lot of investors and analysts will try and make predictions as to what it's going to be in the future. IFRS 13 is fair value measurement. And fundamentally, in accounting, we can either measure assets at their cost or liabilities at their cost, historical cost, amortized cost, call it what you will, or we can try and measure them at their value, at their fair value. And IFRS 13 is the accounting standard that regulates and creates consistency around what we mean by fair value. And in level 1, level 2, level 3, definition, and so on and so forth. So fair value is basically market value. It's the amount you would expect to receive when you sell an asset in a normal transaction. Between informed and willing parties. Not a forced sale. Market participants, not related parties. So it's what you would get if you were to sell an asset. That's predictive. That's predictive. That's in certain circumstances, it is relevant to have an asset at fair value. I would argue when an investment property is at fair value, you're providing relevant information to the investor because you're predicting the future cash flow that could be achieved if that asset was sold. But to be contrary, when we revalue PPE, if we were to revalue our plant and machinery that we've got in our factory to make our products, I would argue that it's not relevant to revalue those assets because they're never going to be sold. And if they're never going to be sold, what's the point in knowing what they could be sold for? So, interesting point. Thank you for listening. Yeah, I enjoy putting together these YouTube little videos. And if you like them, please like them. And please subscribe to my YouTube channel. Thank you very much.